Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Select Medical Holdings Corporation Annual Report. Select Medical Holdings Corporation offers a wide range of healthcare services through its subsidiaries. The company operates critical illness recovery hospitals that provide specialized care for patients with complex medical conditions such as heart failure, infectious disease, respiratory failure, and trauma. In addition to these hospitals, Select Medical also operates rehabilitation hospitals that offer therapy and rehabilitation treatments for various conditions, including brain and spinal cord injuries, strokes, amputations, and neurological disorders. The company's rehabilitation services are designed to help patients regain their strength and mobility after an illness or injury. The company's outpatient rehabilitation clinics provide physical, occupational, and speech rehabilitation programs and services. These clinics offer specialized programs such as hand therapy, pelvic health rehabilitation, post-concussion rehabilitation, pediatric and cancer rehabilitation, and athletic training services. Overall, Select Medical Holdings Corporation provides a comprehensive range of healthcare services to patients in need of critical illness recovery, rehabilitation, and outpatient care. The stock price of Select Medical Holdings Corp. (SEM) has experienced significant drops over the past year, exceeding -17.57%. The primary cause of these declines can be attributed to the company's quarterly earnings reports. Two key events stand out: the first and second quarter 2025 results. In May 2025, SEM's stock price fell by 13.38% in after-hours trading following its Cone 2025 earnings report. Although the company exceeded EPS forecasts, it missed revenue expectations and saw a decline in adjusted EBITDA. The main contributors to this decline were reduced occupancy rates in the rehabilitation hospital segment and fewer admissions in the critical illness recovery hospital segment. The second quarter 2025 earnings report, released in July/August 2025, also led to a significant drop in stock price, with SEM shares falling by 9.91%. Despite beating EPS forecasts, revenue fell short, and reduced occupancy rates in the rehabilitation hospital segment were a major factor. Additionally, the critical illness recovery hospital division experienced a decline in revenue and adjusted EBITDA due to increased costs and expenses. The combination of these factors has led to SEM's stock price drop, exceeding -17.57% over the past year. The company's quarterly earnings reports have been a significant contributor to this decline, highlighting the importance of monitoring its financial performance closely. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline at Select Medical Holdings Corporation, SMHC, can be identified through an examination of the company's financial performance over the past 3 years. A key indicator is the 4.8% increase in revenue for 2025 compared to 2024, suggesting that SMHC has been able to expand its services and attract more patients. However, this growth is not reflected in the company's net income, which decreased by 27.6% in 2025 compared to 2024. This discrepancy may be attributed to various factors, including changes in operating expenses or increased costs associated with providing services. The stability of SMHC's equity, remaining constant at $2,016,931,000 for both 2024 and 2025, suggests that the company has been able to maintain its financial position despite these fluctuations. The revenue recognition policy under ASC 606 is a critical factor in understanding SMHC's revenue growth. By recognizing revenue when services are provided to patients, the company is able to accurately reflect its income from operations. Additionally, the credit risk associated with accounts receivable, particularly those due from the Medicare program, may impact the company's ability to collect payments and subsequently affect its revenue. In conclusion, while SMHC has experienced a 4.8% increase in revenue for 2025 compared to 2024, the decline in net income suggests that there are underlying challenges that need to be addressed. The stability of equity and the credit risk associated with accounts receivable are key factors that will influence the company's future financial performance. The net income of the company experienced significant fluctuations between 2023 and 2025. Initially, it decreased by 8% from $6.2 billion to $5.7 billion in 2024. However, this trend reversed in 2025, with a 22.5% increase from 2023 and a further 16.1% increase from 2024. Despite these increases, the net income still ended up lower at $3.9 billion in 2025. The profit margins also underwent a decline between 2023 and 2025. The margin decreased by 18% from 5% to 4.1% in 2024, and then further dropped by 34% to 2.7% in 2025. However, the increase in net income in 2025 was not enough to offset these losses. The reasons behind this change are multifaceted. The decrease in government reimbursement for services had a significant impact on both net income and profit margins. Additionally, rising costs due to inflationary pressures and changes in import/export regulations further exacerbated the decline. Shortages of qualified healthcare professionals also contributed to the decrease in profitability. Finally, public health threats such as pandemics or widespread outbreaks had a negative impact on the company's financial performance. The company's financial performance indicates a positive trend in operating cash flow. This is evident from the annual goodwill impairment assessment on page 75, which did not indicate any impairment for the reporting units. Furthermore, the financial highlights section on page 96 shows that despite a decline in net income of 27.6% compared to the previous year, the company still managed to generate positive operating cash flow. This suggests that the company's operations are generating sufficient cash to cover its expenses and investments, indicating a stable financial position. The company's debt level and interest expenses have undergone significant changes over the years. In terms of debt level, a stark contrast is observed between two different time periods. On one hand, as of December 31, 2025, the total indebtedness was $1,828.2 million, with no previous year's figure provided for comparison. However, when looking at a longer-term perspective, it is evident that the company's debt has increased substantially, rising from $12,875 to $1,845,414 between two unspecified years, representing a staggering 14,444% increase. Regarding interest expenses, there are mixed signals. On one hand, interest expense decreased by $10,663 in 2025 compared to 2024, and also saw a decrease of $10.7 million from $128.6 million to $117.9 million. However, the term loan interest expense has increased from -$2,293 to -$4,807, indicating an increase rather than a decrease. The performance of various segments and regions has been a mixed bag. On the positive side, the Americas have seen significant growth, with revenue increasing by 62.6% from $75.9 million to $123.2 million between 2023 and 2025. The Asia-Pacific region also performed well, with a growth rate of plus 4.9% in 2025. North America was another bright spot, experiencing a growth rate of plus 12.3% in 2025. In contrast, some regions struggled to keep pace. Europe saw a decline of minus 76.4% in revenue between 2023 and 2025, while Latin America experienced a growth rate of minus 15.1%. The Middle East and Africa region had a modest growth rate of plus 6.7%, but this was not necessarily poor performance. The critical illness recovery hospital segment has a strong presence, with 104 hospitals in 28 states. The outpatient rehabilitation segment also has significant growth and presence, with 1917 clinics in 39 states and the District of Columbia. The company has made several strategic moves through acquisitions and divestitures in recent years. In terms of acquisitions, the most notable one is the take-private transaction with Mr. Ortenzio, which was mentioned on page 48. This transaction marked a significant shift in the company's ownership structure. Additionally, the company has been actively pursuing opportunistic acquisitions, as well as joint venture relationships with large regional health systems and other healthcare providers. These partnerships aim to expand the company's reach and capabilities in the healthcare industry. On the divestiture side, the company has separated from Concentra, a significant move that involved distributing Concentra shares to stockholders on page 36. This separation was also mentioned as a divestiture on page 48, highlighting the company's efforts to restructure its operations. Furthermore, the company has disposed of certain subsidiaries, as noted on page 115. These divestitures demonstrate the company's commitment to streamlining its operations and focusing on core business areas. Overall, these acquisitions and divestitures reflect the company's strategic efforts to adapt to changing market conditions and optimize its position in the healthcare industry. The company has demonstrated its commitment to returning value to shareholders through various means. One key aspect is the payment of dividends, which has been a consistent practice. In fact, the company made 4 dividend payments in the year ended December 31, 2025, with each payment amounting to $0.625 per share in 2026. In addition to paying dividends, the company has also engaged in share buybacks as part of its strategy to enhance shareholder value. A significant stock repurchase program was authorized for up to $1 billion worth of shares, allowing the company to purchase a substantial number of shares from the market. Specifically, 39,001 shares were repurchased in November 2025, while a total of 6,375,512 shares were bought back during the year ended December 31, 2025. That concludes the financial summary for Select Medical Holdings Corporation. Feel free to comment below, and I will be happy to answer them when possible.